Okay. People have appeared. Right. Oh, and many participants. This is very exciting for 400 million Zooms down the line. Welcome to the first in a series of hotel investment alignment webinars hosted by Watson, Farley and Williams. I hope everyone is having the most exhilarating Wednesday morning they possibly can have. Just a few housekeeping tips. Please note, as per the slide you've just been reading, that video and audio have been disabled to minimize interruptions. This is not a judgment on anything that you might interrupt with. If you do have interruptions that you wish to interrupt with, I will be keeping an eye on the chat. So if you have any questions, do ask. There'll be time for Q&A at the end, but anything that I think is suitable to be slipped in during the course of the debate, I of course will. Alternatively, you can contact the speakers direct after the event. I'm sure they would be utterly thrilled to hear from you. Balance is key in all things, and what we've learned during this pandemic is that it's very easy to lose as we all work and live from home. But the stress of the pandemic has forced owners in the hotel sector to look at their relationships slightly harder than they may have looked at before, and they have become, as a result, slightly more demanding, as we're going to be hearing from our panelists today. So first of all, I'm going to allow the panelists to introduce themselves, should they so wish. And then Felicity is going to kick off by telling us how she sees the current state of play. So should go left to right, assuming everyone can see my left to right.
Katherine, I see introducing myself, well, I hope that most will know me. I head up the global real estate side for Watson, Farley and Williams, but my main focus is the hotel and leisure market. And that's for management contracts through franchises, acquisitions, portfolios, and the whole gamut, really.
Wonderful. Lionel? Or fresh from Sky News, Lionel, in fact.
Thank you. I co-founded Go Hotels with Viv Watts in June last year. We found a hybrid lease solution model that we felt would appeal to some of the Travelodge landlords who were falling foul of not receiving rents. We've secured 10, we're up and running, and I'm happy to be joining you guys today to discuss the state of play of the industry.
And Robert.
Katherine, Felicity, Lionel, and everybody joining us, a very good morning. I'm the Managing Director of Maze Hospitality. We provide solutions for owners, investors, and hospitality companies, asset management, development projects, brand strategy, and the like. Prior to that, I was the Chief Executive of Grace Hotels for 3 years, which was a luxury boutique operator. And before that, I was with the Jumeirah Group for 11 years as Chief Operating Officer, Chief Development Officer, and starting life there as General Counsel. So moving from being a lawyer to the commercial and operating side of the business.
Wonderful. So Felicity, how are things? Is it all exactly the same as it was before we went into this, or have there been some shifts, some grumblings, some happiness perhaps?
Well, it's very tough across the globe. You know, we can see some glimmers of light for some across the sector. There's been some increased flexibility. The low interest rates and the government support are not going to save everyone in the sector, much as we'd like them to be able to. But as we go forward, I think what it's shown, whether it's the insurers being difficult or whether it's lenders having to hold their fire at the moment, the way in which the brands have very helpfully dealt with flexibly with certain capex requirements, etc., we still need to have a better fundamental balancing of the risk that recognises the brand value, but I think gives more transparency and works towards an alignment of interests. And quite frankly, I'm not seeing that yet as the vision for the future. It's what I think should be the vision for the future, and I hope we'll work towards it with both sides recognising the value of the other, but recognising the trauma, in particular to owners, through the last year.
Indeed. So Lionel, you grew out of this, and the Travelodge saga was everyone's required viewing last summer. I know we're all particularly gripped by it, and you know there are a lot of exciting twists and turns, and we are where we are now. But I think that there was the sign that maybe there could be another way. Do you think this other way is something that owners have now grasped, or do you think after the pandemic they'll go, well, you know, going to put a brand up above the door, maybe more the kind of the sort of the, without wishing to tar with one brush, the kind of the Travelodge owner, which we saw, who maybe has other assets, maybe is in retail and offices and things, you know what, I'm going to put a brand over the door and then I'm going to go back to doing what I was doing before, concentrating on my banana bread? Or do you think that there has been an increase in education which is starting to trickle down into the sector?
Thank you, Katherine. I think there has been an understanding, a broader understanding, that the rental guarantee market for a landlord, the word guarantee, it doesn't really exist at this moment in time in our economy. So those landlords that have had the hotels and expected the rent check have probably had retail and other office space where they've seen the same kind of situation where tenants can't afford to pay the rent. So I don't think it's, as you say, it's not just Travelodge owners. The big hurdle for us in trying to convey the message is the education and getting a landlord to buy into the hybrid lease model and to accept the fact that no longer can I rely on 100% guaranteed rents. When they actually saw they weren't receiving rents and it started hitting their pockets, that's when suddenly, obviously, they start to pay more attention. And we try to explain that there'd be risk and reward, where you can have a brand alignment where with our core, with Ibis Budget, we've got the brand sitting at the table with us and we're not on other sides of a table, it's a round table and we're all sitting in this together. And the alignment of having landlord, brand, operator together has meant that those who did join us, and it's only been a small number in comparison to the Travelodge portfolio, they were always our biggest competitor. We secured 10 hotels. And those landlords like the idea of risk and reward. They're more commercial, they have the acumen. And as you say, it's not just about Travelodge, this is something for the future. This is not just about having Travelodge who are in some dire straits. It's more focused about what is the future for our industry. And can we get brands to work hand in hand with a landlord? Can we have operators who can support those landlords that are not necessarily hospitality people, that don't want to be involved in the day-to-day? And is there a place for all of us to coexist together and ultimately provide a service to the guest? Because we all forget about the guest. And the hotel guest will actually want to stay in that hotel and pay our way, because without that guest, no one pays our way.
Oh, the guest. So I like the sound. It's all very, very King Arthur, this whole Knights of the Round Table bits. I can just see now the glowing brand coming out of the lake. Grasp it and all will be well. But to play devil's advocate, we have seen the brands of the public face and of the sector, and we've seen a fair amount of suffering on the part of the brands. The brands have said, we've dropped fees, but of course, there are no fees to give. And there has been a reasonable amount of suffering. Do you think that they have suffered enough, that they have, their reputation is on the line? If something goes wrong, it's usually the brand, it's not the owner who takes the hit in the face. Do you think that they have been doing what they could do, or do you think that there are other areas where you mention guarantees? Is that you like to see something written down rather than just, but my tarnished reputation?
Oh, there's a fair comment. The brands have suffered. There's no question. I mean, they've got a cash flow issue. I'm sure they're burning a lot of cash to keep businesses open. And we have a very small cash burn in relative terms to what they would have. But for our business, it is hurting to have hotels that are closed and having to still fork out money. Thankfully, we have furlough. Thankfully, we have the business rates, etc. But the brands will certainly be suffering. They're burning a lot of cash and they've got to stay afloat. So they've got to look at alternative means today and alternative measures. And we've had this before in the housing market, when you see the housing market, burst a bubble and suddenly there's got to be what we call price adjustments. And suddenly there's a price adjustment on something. And I think the equivalent of the price adjustment is the brands taking alternative views and being more flexible. We need brands to want to feel the need to work more closely with landlords, with owners, so that they can catch up and develop. We need to be able to see the development pipeline sustained. We need to see the industry sustained. Brands will need to help with that. I think they have helped when it's come to some hoteliers who I've spoken to who've said, look, they've relaxed a little bit on the capex. They've given us a bit of a wide berth in terms of certain criteria that they want money for and normally would want money for. But they are hurting, and I think it's lessons to all of us. Everyone, no one's impregnable, unfortunately. It's we're all being hit by this, and how do we learn from it? How do we move forward as an industry? We've got so many hotels in this country that are probably on the brink, and the banks have sort of given some headroom because they don't want a repeat of 2007 and 8. The brands won't want to lose out on landlords. They won't want to lose out on owners. They're going to want to be able to secure their constant income stream. So come to the table with more flexible approach, give more guarantees, give more credence to your brand. Believe in your brand. You believe in your brand, then you should be able to say to the landlord, I believe my brand will deliver this minimum. I believe we do have 100 million plus loyalty card owners, and therefore we will be able to give a little bit more to the landlord to entice them in to our brand versus the other. And the brand that does go down that road of finding the solution to enticing the landlord will probably come out on top as we come out of this pandemic.
We have seen some moving in that direction, but certainly with some of the larger organisations, which I see more like a huge ocean liner that has more difficulty moving around, I can't at the moment look to the future and see more flexibility in the fundamental agreement. And I think that's where there probably needs to be, because an owner at the moment looking at the future can see a little help on the capex here, possibly more help with IT solutions, some enormous help with some of the above property costs. But whether that's going to continue is another issue. And what I would like to see is a little more certainty for the owners as they start to emerge from this, a little less, perhaps more recognition that they've invested a huge amount of capital in an asset and they're coming together with a brand and the interests are aligned. And that's not just aligned by virtue of an incentive fee. I wouldn't necessarily think we'll manage to get guarantees in all circumstances, but certainly if a certain amount of room nights aren't being delivered by the system, then the ability to discuss and possibly walk away rather than a complicated performance test. So that's rather going for the centre of it. But I think those are the things that go to value, that will help owners going forward. And hopefully we'll see more of.
We'll come back to valuation and the brands and banks and whatnot in a minute. But Robert, with the question of education, do you see that there's a likelihood that going forward we'll get sort of brands who are with a brand, you're an uneducated owner, this is how it's done, here's your brand book, this is how you put a club sandwich on a plate, and you're going to get the more savvy owners who are more able to say, look, I don't sell a lot of club sandwiches, I don't need all these plates, and you can take your pillow menu, let's talk about what we're going to do. Do you see that sort of a two-track branding approach, or is it the case that after the pandemic, you'll just have to have a brand and you'll just have to suck that up?
Look, I mean, I think probably there are more owners that are more sophisticated and educated about engagement with brands and the terms and agreements that they enter into with brands than we perhaps give them credit for. And so I think you've got so many people on the both law firm side and advisory side now that owners can turn to get proper advice on leases, management contracts and franchise agreements, that education is something that is very easily accessible. What we've seen historically from the global brands, and I do make a distinction here between the truly global dominant brands and what I refer to as perhaps small and emerging brands like I worked for, Jamel Group, Grace Hotels, is, historically it was the brand book, the brand standards, the CapEx plan, the standard term of the agreement, the standard operating fees, the standard termination provisions. What we have seen quite clearly during this pandemic, rightly, brands exercising some flexibility around things like CapEx holidays on brand standard suspensions and the like, to try to assist ownership. And I think, as Lionel's recognised, the brands are suffering as the owners are suffering, because neither are in receipt of income, and therefore servicing debt is a challenge. But I do think going forward that there should be an expectation on the side of ownership that all brands, whether global or emerging, should be more flexible in terms of their approach to the management contract, whether it be the term, whether it be the fees, design guidelines, all their expectations around CapEx. And I think those brands that are prepared to adopt that flexible, adaptable approach that is relevant to the specific market in which they operate or a hotel operates, and to the specific owner with which they're dealing, will emerge from this much more successfully than those brands that stick to the inflexible, by the book, we've always done it this way approach.
We saw at the beginning of the pandemic, a lot of the larger brands hoped that they were going to see a lot of conversions, which is traditional in this kind of scenario. And certainly this was something that came up in the Travelodge saga when the opportunity was there. But that didn't really play out. It's kind of accelerating a little bit more now, but putting any different sign above your door costs money. No matter, if you've got no one coming, you've got no one coming in. Converting to somewhere else and having a different sign doesn't really mean anything. But we have seen an increase in the collection brands, and Radisson has launched a brand which is just a lot more flexible. Felicity, is there any difference in these sort of collection brands? Do they provide more flexibility, or is it more of the same, do you think?
In theory, they do offer more flexibility, but it does vary from brand to brand. And I've been quite disappointed recently to see that a very similar contract being produced for a collection brand as you would see for one of the main brands. So it's almost as though the collection brands are moving into being just another proliferation amongst the proliferation of brands that are being produced. I think the theory is good, and I think the intent is good. I think it just needs, again, to recognise a greater flexibility, probably in more than design standards. So it's not just a name on a door or a place to park something. It's a distribution system that people are buying into, but it should have a different edge to it. It should give the owner that much more flexibility. But overall, I have sympathy because I know the brands want to maintain their preeminence. But you do wonder sometimes with some of the deals that are happening and the proliferation of the brands, whether all it's doing is damaging an owner.
But I think, one of the things, Felicity, that certainly I'm seeing in some of the projects that we're working on at the moment is significantly more pushback on things like term of agreement. Those global operators presenting agreements looking for 40, 50 or 60 years are getting significantly more pushback now. And I think the realism is that people are expecting 15 years, perhaps renewable for another 10, and in many cases less than that. I also think as well that when it comes to flexibility around other terms, that you are seeing some movement, or certainly I'm seeing some movement with operating businesses. But again, it is that distinction between those brands that are emerging and want to expand, and those brands that have what I refer to as global dominance. So in the time, for example, that I was at Jumeirah, we were much more flexible on terms. We were much more flexible on our engagement with the owner because we had a desire to grow that brand. Now, we didn't want to grow it at any cost, but we wanted to have hotels that were appropriate for the marketplace in which they were located. And so we didn't have a one-size-fits-all approach. If in a particular market, a particular room size and approach was appropriate, then we would adopt it. And I do think that owners now will demand, quite rightly, a much higher degree of flexibility. Being able to demonstrate that you can deliver fair market share, being able to demonstrate that you can ensure that the hotel performs is the baseline entry-level minimum. And I think ownership will expect brands to operate in partnership with them rather than, like you described earlier, sitting around a round table And I think that's exactly right. It's people sitting around a round table rather than sitting opposite. And it has to be a much more collaborative, partnership-driven approach that suits the owners as well.
I do think actually what we will see emerging from this, well, we've seen already the trend to many more experienced owners. And I think that's what will drive some of this and hopefully drive some more balance, because they have expectations. A comparison years ago with the car industry, some of the big brands preferred to have the small owners or the more individual owners, because if they encountered PLC owners, the PLC owners were much tighter on budgets with renewing showrooms and things like that. I think there's a parallel here, that the bigger owners, the private equity owners, more experienced owners will have better deals and more power, without doubt. So I think experience, as well as transparency, I do believe that going into this, there should be more clarity as to exactly what the charges will be, how they're put together. I don't necessarily want to contain brands who are innovative and have a way of ensuring delivery and developing. But on the other hand, I do think in any other business, an owner would expect to be able to calculate their costs, and at the beginning of the year would have a certain amount of a certainty. Assuming, of course, we emerge, and we will emerge. So
I think it would be a fairer option to all parties and give a lot of clarity. And I think the brands would be rewarded for it if they came up and said, there is one fee. This is the fee. There are no additions. There are no extras. Okay, there'll be an incentive if we get over a certain hurdle, but the fee is the fee. There's no group services and benefits, and there's no IT costs, and there's no other HR administrative costs. There is just a fee. And I think the brand that comes out of the melee of brands and says, this will be our fee. It is a percentage of whatever, whether it's revenue or it's GOP or it's EBITDA. And this is our incentive. If we go over for your hotel, that £1 million EBITDA hurdle, whatever the hurdle is, we get an extra thank you very much for our hard work and effort. If you have that clarity as an owner, it just makes it so much easier.
I mean, I certainly think there's a degree of flexibility being shown by the brands when it comes to, for example, ramping up the base fee rather than going in straight with a higher base. When it comes to ramping up the incentive fee based on performance rather than going in with a fixed higher amount. But I don't think we'll see a shift to the fee structure that either you describe, Lionel, or Felicity, you might desire for some of your owner clients very quickly, because of course, the brands are looking for compensation to get out of bed in the morning and operate the hotel. They want the upside on the results that they produce as a result of their marketing distribution system. But then, of course, they carry, most of them, they are significant and global, a huge amount of corporate overhead that sits above the hotel property. And of course, the desire is to charge as much of that into the hotels as they can, where it's of direct benefit to the properties. So I think we'll see owners demanding much more flexibility, and in many cases getting it. But I think it's going to be a considerable time before we see a fundamental shift to a very different fee model.
Unfortunately, I tend to agree, but I think we will be moving in that direction. And you did use the words direct benefit, and I think that's one of the things that owners should be looking at more closely, and particularly if there's going to be less international travel in the near future. If there's going to be more domestic use of the hotels, then there should be more focus on the domestic marketing budget. So it's interesting to see how that will be carved up.
It's intriguing, isn't it? Because at the moment we have this sort of, to use a Brexit analogy, this kind of European Union scenario where if there's one failing hotel, everyone else has to kind of, or country, everyone else has to kind of pile in and pay for it and take it on the chin. But really everyone wants everything to only benefit their own hotels, which is why there's a massive difference between capitalism and the European Union. Anyway, away from paying them to get out of bed in the morning, we have a few questions from the floor, one of which I'll be inserting later, but one of which is exhilaratingly relevant now, which is, does the panel see the pandemic accelerating the trend where more experienced owners switch from management agreements to franchises and operate the property themselves, or through a white label operator? Is this giving everyone lots more exhilarating power and the chance to snap back? Felicity.
Well, I have to say, I don't think I'm alone in thinking that the franchise and management agreements are very close in some respects in terms of the lack of direct obligation on the brand. So having prefaced it with that concern, the third-party operators and franchises is a well-trodden path. I know a lot of the brands prefer to go that way, possibly not so much at the luxury end, but that's starting. And I think it's a model that works. I do have a slight reservation with some of the third-party operators, to the extent that there's got to be a closeness to the brand, and to a large extent that can benefit an owner. But there must be circumstances in which, as a third-party operator, you probably don't push and challenge quite as hard, because you know that's what's being done in the other 30 hotels that you're managing. So are you driving as hard for an individual owner as possibly the owner would like to see?
It's tricky, isn't it? Because when it comes down to it, no one wants to operate hotels. And this takes us to another question, and back to the valuation issues. We had possibly one for Lionel. Everyone enjoys the idea of a hybrid rental lease, and it's been tried in various different locations before now, but never with quite the prominence than this. But how do you get the institutional funds to look at this and to not scratch their heads and say, this is confusing for me, how do I plan? They too can't, for legal reasons and other reasons, want to operate hotels and get too deep into the weeds on all this. How do you sell this as a new model, and how would you value all this? Because it would be interesting to talk a bit more about valuation and the roles that the brands play, particularly in the pandemic. But Lionel, how do you attract the institutional funds?
It's a good question, and Andrew knows the score. When you look at the responses we had, it was all about the level of guarantee. So we could have possibly achieved a more significant number of hotels switching to us if those institutional investors had more of a guarantee. The word guarantee was very important. The word risk is the one that they want to avoid. So being a partner with Accor was very important. We needed a big brand with us, and this is where the importance of the brand does come to the fore. We needed to have that, and I think this is where the banks and the valuers were seeing the same kind of response. It wasn't, who's a Go Hotels, who's Lionel, who's Viv, we a couple of entrepreneurs, okay, one's a hotelier, the other guy owns a couple of hotels, but we needed the partner at the table with the brand. So this is where you can't decry the value that they've built up over X number of years as a brand. So that was essential. And I think it's education. It is saying to these institutional investors, are you willing to leave your hotel without any rent because it's with a big brand above the door? And there's no question that Travelodge is one of the biggest brands in the UK, probably the second after Premier Inn, in terms of the number of hotels they've got. I'm sure one of the brands who's listening will correct me if I've got that wrong. But certainly, Travelodge can't be denied the fact that over 35 years, they built up 588 hotels. That's a big brand in anyone's book. So why would I leave that big brand for someone else? And, I'm not getting any rent. Yes, but I'm with the big brand. They will come back. They will come back and it will be fine. And that reliance, because of the power of persuasion, power of brand, has meant that so many did today with Travelodge. So I think moving forward, what we need to do is try to prove that these models work financially. We need to build track record. We need to show valuers and banks that we can pay our way. When the valuers look at the 50% rent guarantee, I wouldn't quite say it's a ground rent. I wish I could, and had the same value as a ground rent. It doesn't, but it does have a very good value, because when you're paying someone 50% of what they were achieving is 100%, they know that 50 is more secure. So a valuer will feel more comfort, and again, to those valuers that are online, they perhaps will comment. The valuers I've seen who valued the hotels that we're working with have said, yeah, that first 50 is valuable. Now we've got to educate the investment community in saying that first 50 won't be valued the same way that a franchise income would be valued, because it is guaranteed. And it's not Lionel and Viv guaranteeing it. It's not the Go Hotels, just Lionel and Viv. It's Go Hotels with a third partner that happens to be Accor. So that's very important to them, and that's how they've looked at valuing that first 50. Now the balance has been looked at as a franchise income basis for valuation, and when you blend the two together, the result is that the valuers who have valued the hotels that have joined us, and the banks that have been funding hotels that have joined us, have all bought into that. So it's about spreading that word, and it's education. It's about talking to the landlords. It's about convincing the landlord that actually there's upside in this model. And if you're a long-term hotelier, today you're looking at how we can acquire more assets, how can we evolve our businesses, how can we grow. If you're in it for the short term, you're probably, oh, it's a bit squeaky at the moment, not sure if I want to stay in this sector, but where are you going to go? Are you going to go to the retail sector? Where are you going to go?
It's always worse everywhere else, fortunately.
Yeah. So I think it's education. We've got to educate people into the fact that post-pandemic, when we build up our businesses again, we've all seen the pent-up demand over the summer. We've all seen these. You just listen to Robin Rossman talking about the countries where occupancy has come back, and where the STR data has shown that as soon as you open your borders and you're no longer a red country, everyone wants to get away. We can't take a virtual holiday. I'd love to be in that background that Robert's got, but you can't do that virtually. You've got to go and feel it and experience it. We can't have holidays virtually. We can't ski virtually. So the leisure industry will bounce back. Corporates will want to get back to some sense of normality. Possibly the length of this pandemic will mean that certain of our routines that we were used to will change. Look at what we're doing today. We'd have normally met up in Felicity's office, and she'd have given us some tea and biscuits, and we'd have then had a round table over there. But we're doing this online, so some things may change. But ultimately, I've been a proponent of talking about physical distancing, not social distancing, because we as humanity want to socialize, particularly the hospitality industry. We are the doyens of being, socialites. We want to get people together and go out and get the hospitality industry back and moving and experience it firsthand. I think when that happens, we'll have physical distancing, but we'll still socialize, and the hospitality industry will grow. Again, it take us some time, but we'll come back, and we've got to educate people in the interim that the industry is here to stay long term. So find alternatives to how you operate, and that's the brands, it's the landlords, it's the banks, and it's the valuers. And it's us. We've got to be innovative. We're known as innovators in what we do. The only thing we probably haven't changed is, how you clean a bedroom. It's probably been the same for the last 100 years.
With the owners. It really has to be brands working with owners, so that the owners can look at the different models. More of the, you've seen some quite innovative ideas of people in due course being able to work in different hotels across the world and always have their working space and effectively working from home, but in a lot of different locations. It's seeing more thinking along those lines.
Felicity, don't you think that the banks and the valuers are going to have to, towards Andrew's point, the banks and the valuers are going to have to play ball with us, because they've got to be able to accept that if a landlord, an owner, wants to go down a particular route, and he believes that financially that's the way he wants to take those decisions, he can't take them if his bank doesn't buy in or the institutional investor doesn't get board approval. They've got to be able to see that there is this commercial approach that they've got to take as well. They've got to switch mindsets and saying, we don't want just this 100% guaranteed income. That really, is it going to be guaranteed? If there's another COVID-23, God knows. But if that was to come about, what are we going to do? So have a bit of risk and reward, and be a bit more entrepreneurial. Can an institutional investor become a little bit more entrepreneurial?
But it's quite interesting when you think of the brand you've already mentioned once before, walking away from leases, and then again 10 years later, it's walking away from leases again. So the landlords must have had faith in the old-fashioned lease model shaken, pretty heavily shaken.
Oh, I shouldn't have mentioned the brand name, sorry.
I think everybody knows that one, Lionel, so I think that was perfectly fair.
In that case, I won't mention the huge success that Delata have had with paying their rents, and now everyone wants to get in on that. Shouldn't mention them because that would be favouritism and talking to, so we won't talk about that. We also won't talk about ground rent because we don't have time. Although anyone who knows me will know that I love to talk about ground rent. Possibly too much. While we're talking about agreements, we have a question from the floor. At a high level, can the panel, so I should go left to right, Robert, Lionel, Felicity, summarise the changes in management agreement key terms that they would forecast once global demand has returned? And I think that the return of global demand is going to be a very interesting thing because we're all desperate to get into Robert's backdrop, but how many people will be able to afford to and what that will look like and how staggered that might be, I think is likely to drip out over the course of the year. And we're going to get to M&A in a minute, but I think that we're going to see a lot more change before we have anything like stability in the sector. So, Robert, what do you think?
Well, on a sort of quick trot through on what you'd expect on HMA terms, I would say owners will probably be expecting shorter terms than they're getting presented with at the moment. A shorter initial term with a period of renewal. On operating fees, I would imagine owners asking for a lower base or in some cases no base for a period of time, and that operators operate on the basis of incentive fee only, i.e. they get a reward for the upside. On performance tests, I think we'll see people like Felicity pushing hard to change a lot of the language in there so that it's not just on the percentage of budgeted GOP and RGI on the concept, but that there are other options around performance for owners to terminate. I think we'll see a considerable push for a stretch on CapEx or CapEx holidays, particularly in the initial reopening period before owners ramp up and start to see cash flow again. And I think on new projects, we'll start to see very much a focus on operator guarantees, so minimum owner return. On new deals, I would expect there to be even more of a focus than there is now on demand from owners for key money. And when it comes to things like termination rights, I think we'll start to see the owners become much more aggressive on the basis on which they can terminate management contracts. Because at the moment, as we all know, it is very challenging to do that without getting into either complex arbitration or litigation. So that's a very quick chop through of some of the key terms on where I think we'll see some significant shifting changes.
You mentioned profit earlier, and I know my accountant likes to talk about it all the time, but you don't see it so much in this sector. Do you think that there should be more structuring around profits and whether the brands should be looking more towards that and more towards the alignment around profit than around maybe the other things that they look at?
Well, I think there needs to be more of an alignment of interest between owners and operators when it comes to focusing on profit. I mean, if you take management contracts as they are at the moment, most of them, the operator will get a base fee, which is generally a percentage of the top line. I think if I'm sitting in an ownership position, I'm going to want to see less of a reward for that and more of a reward for what's converted into profit. And therefore the interest between owner and operator are fully aligned. And I think there'll be a big push towards that. I mean, I'm working on two projects at the moment, one in the Middle East, one in Africa, where the idea of the base fee is off the table, and incentivization is the only reward that the operator will expect for operating hotels.
See, that's why I have one of my concerns with franchise agreements, because in those circumstances, you would have some of the regime that you're under with a management contract, but you can't push quite reasonably. You can't push the brand on the profit side because they'll say, well, you're operating the hotel. So there is a little shadow in my mind about some of the franchise arrangements, and certainly particularly when they're given very long terms. and there's no termination related to occupancy being driven into your hotels.
But the owner arguably has more control though on the franchise side than on the management side.
Agreed, but there can be the cost issues.
Yeah. The cost being pushed in from the centre, you mean?
Yeah.
Yes. No, I agree.
Yes, I liked Lionel's one fee for everything model, and I think that kind of really is how things started out, as far as I'm aware. But then sort of you go along with your one fee, and then you think, well, I need to now have all this ESG stuff, and maybe it's going to cost more if I process my water in this way, and then I'm going to have to bolt that on, and then I think there's this terrible risk of, particularly with ESG and the likes, that you end up with a cost creep.
But in its way, I think that's one of the benefits of the brands, because it's a very hot topic. It will continue to be a hot topic for investors in the funds. So I do think that that's where a brand can bring to the party a governance that is helpful, is very helpful in terms of the ESG agenda. So
I think it's about transparency as well, and the expectation of most owners is that they're going to see a base fee as a percentage of the total revenue, that they're going to see an incentive fee as a percentage of the GOP, that they might see a sales and marketing fee as a percentage of rooms revenue, and that's all fine, and that's all disclosed by development teams and sits in LOUs and is very visible. What's less visible from lots of the brands is what sits behind it in terms of centralised services charges, those things that are pushed in from the corporate centre. And a lot of the times when we're engaging in these discussions, one of the questions is, well, if I'm paying a percentage of rooms revenue for sales and marketing in relation to my property, why am I then paying for a whole series of other activities which arguably fall under the description of sales and marketing? And I think having absolute disclosure and transparency around centralised marketing or centralised service charges that come from the levels, and it is levels, not a level, levels that sit above hotel properties is really important. And I think there will be a big push by ownership to see further disclosure and transparency in that regard.
And if you're getting really into the nitty-gritty, there are also tax issues and with grossing up provisions and exactly where the services are being provided for, with a global trend towards making sure that all income is taxed in the jurisdiction that wants it most. It's a tricky issue, and those will need to be looked at very carefully.
It's not going to be an easy time for the brands.
But they need support too.
Yeah, that's what I'm saying. I don't think it's going to be easy for them. I think when they come out of this, they're going to. When we come out of this as a society, they will have suffered quite a significant hit. So it's not going to be easy. So I think it's about innovation. I think Robert absolutely articulated all the points that are relevant in terms of what we would imagine. Owners, landlords would be looking for. The brands have got to then decide how much can they really give on this, and how, if they don't give in terms of flexibility, what will be the impact on their longer term business? Because if one brand was to come out of the box and say, right, you know what, we're going to buy into this change and evolution, and for the next however long period we're going to amend how we operate. When one starts, is that going to be the catalyst for the others, or is that one going to be? And I think, as you said, it's the global brands, Robert. It's not the smaller brands. The smaller brands can be more innovative. The smaller brands can be given more. You must by the owner, otherwise I won't come. So the smaller brands would have to give a little more.
But the other thing I think that we shouldn't lose sight of, and I, as you know, come from a relatively recent brand background, is that a lot of management companies, particularly bigger global management companies, are asset light, and therefore the assets of their business are the management contracts. And so when we start talking in the way that we are talking about changes that might be made to, you know, fees and term and termination, etc., that all has an impact on the value of that contract, and that ultimately has an impact on the valuation of any management company. I mean, Jumeirah, for example, when we started, we had a number of hotels that were owned and managed, but as we went on our global expansion journey, that was very much focused on an asset-light model. I mean, sure, on certain projects, we might put sliver equity into that. On other projects, we may have put key money in, but that was a show of goodwill and a demonstration of good faith to the owner, not in a position or share in risk of our real estate. And so our management contracts were our assets, along with all of the other things associated with the brand. And so we do have to bear in mind that fundamental shifts and changes will have an impact on how it is that management companies are ultimately valued.
Well, you see, you say that, and we were concerned ahead of this panel that we were going to be bashing the brands all the time, and it's very sad, and possibly they might come for us in the night, which would also be very sad. But it occurs to me, looking at the questions and hearing what everyone's been saying, that the implication is if we get more flexibility, it will be bad for the brand. But surely, without wishing to sound too much like someone who used to live in Brighton, it doesn't have to be a zero-sum game. If things are better, if hotels are operated better and more efficiently, doesn't everyone win?
Well, that's the aim, isn't it? We're all aligned. I mean, I think that's the key. Everyone will win when we are sitting around the table together, when there is skin in the game, and that's when everybody becomes a winner. So there needs to be some sort of a shift, and I think it is coming. We've spoken about brands that are making a difference today, that they are changing in terms of flexibility on length of term of a franchise or length of term in terms of management agreements. And then it's a matter of the finances, isn't it? It's always going to be the finances, and it's always going to be about the other parts of the jigsaw. It's not just the brand. And I think there's a question that I saw in the room that I think came from Simon about lenders, and if the lenders are actually, you know, forcing landlords to go down a particular route because the lender wants his security, the lender wants his safety, and the valuer is also inclined in that direction. There are many parts of this jigsaw. It's not just about the brands. It's about the investment community that, you know, gives the support to our industry, also buying into alternatives.
But I do also, you've got to also look at the concerns that must come from things that will ultimately cost the owners. And I wasn't going to get into loyalty programs on this particular talk, but you see brands raising funds from issuing lots of points. Well, ultimately, there is a cost to the owners for those points.
But there's an upside. There's a massive upside, isn't there, Felicity? Because it's the distribution. I want to buy into distribution, and I've got to have a big brand above the door that plugs into 100 million plus loyalty users, and that gives me that distribution magically. And I think, you know, suddenly I know that if I've got your brand above my door, suddenly I tap into those 100 million. Now, how many of those are relevant to my market? How many of those are really active users? Okay, there's another discussion. And yes, it does cost something, but I guess that's a really big value. It can be a massive market segment if suddenly everyone's coming in. And Robert, you had something with a hotel that you mentioned that they in pre-com that you mentioned about a hotel that changed brands.
Yeah, sure. I won't mention the hotel or the brands, but it was a.
I did avoid that this time.
Yes.
No, I think back to Lato again.
Significant and flagship hotel, and it switched brands. And when the new brand took operational control, you saw an immediate increase in occupancy, and that was driven predominantly by the fact that they had such an enormous loyalty scheme that they were able to offer their members redemption. And that's what a lot of the occupancy upside was driven by. And so you're absolutely right, being able to plug into the type of distribution network that some of the very large global brands have is absolutely key. And I think that's one of the big considerations for any of the owners is how am I going to fill my hotel? Who is best placed to drive occupancy and rate, and ultimately profitability for me. And that's a key assessment, not just for the owner, but also for any lenders involved. And we haven't talked much on the session today around distribution, but that is a key point, I think, that the brands will focus on, because they are ultimately responsible for driving revenue into the hotel.
Yeah, and so we'll talk about distribution on future webinars, so stay tuned, because, you know, as ever with these things, it's not as simple as it might sound, but that does kind of drag me effortlessly towards talking about M&A, because one of the things that you do if you get into one of these brands is you think, I want to be part of this distribution network, I want to have 600 million people all earning points and cashing them in, it's going to be amazing. But then what happens when you find yourself sucked into another company and the hotel over the road is suddenly on the same distribution network that you are on, and suddenly, and maybe you're only one, and the guy over the road has 6 hotels and gets on really well with insert CEO's name of choice here. What do you think? And we are going to see, we can all see it, we can hear it, lots of us are involved, not me, but many people are involved with the deals that are about to break. What difference is M&A going to have to all of this and to the hotels involved, and is it going to be to their benefit or not, Felicity?
Well, it's always a concern, isn't it? Because even with one particular brand, if you're not getting a decent territorial cover as an owner, you will probably only get a territorial cover for the particular brand. They split their brands, and you have a pretty similar brand up the road with a few distinguishing features. The market gets a bit tight, and which hotel are people going to use? If one is dropping its rates but slightly more upmarket, are people going to choose that one rather than the one further down the road? So it's a very tricky conundrum, and I can understand that the brands have their global aspirations, global in terms of all the different types of brands and products within the hotel sector, and extending to service apartments and extended stay. But there has to be an issue for an owner. I cannot accept that having 6 hotels within a city centre can of a similar type can really be beneficial for every owner. There will be those that lose out. So unless Lionel can disagree with me and put me straight.
So no, I think the question is how brands evolve, because the brands want to have more market share all the time, and the development guides are all incentivized to try and get those brands above the doors, and they're restrained by AOPs, so they're trying to limit the wording that goes into those AOPs to be branded own, single brands, rather than having a big brand that says none of my brands can come into Brighton. So I think what we'll probably see is, again, it's all competition driven. But this is why we see all the M&A with the big brands coming together. That's another reason why new brands are coming up. There's ways around the saturation point, and those ways seem to be by companies amalgamating and just creating a new brand. But I guess the brand people who are listening, including those that I work with, will be kicking me for saying this. But at some point in time, will the brands be overtaken? I can see, Thomas's question about Airbnb is very interesting. There's always going to be an alternative out there, so we've got to be innovators. We've got to stay at the forefront and find solutions that work for everyone. I think the AOP definitions and again, it's going to come to lawyers and brands and how they protect themselves, but it's a challenge, big challenge, because we've got so many brands now. There's so many brands around the UK. Is there room for the independent operator?
Yes, undoubtedly there are some that are very different and innovative, and it's exciting models, and I can see the distribution network of the big brands being amazing for some of the smaller boutique products that we all know that they're looking at the moment. But at the same time, to be in a situation in a major city in Europe where you have a hotel with a particular brand, and then suddenly it pops up with the same name and Central put next to it. Where does that go in the stack when the the guest comes to book.
Well, you're going to upset the owners, you're going to upset the guests, and you talked about guests. I'm glad you mentioned guests as well, Felicity. They are so important, and it is confusing for the consumer. When I worked for a brand and we had a number of hotels that were under the stable, it was very confusing, to actually really be able to say to a new investor in the sector, why should you go for brand X within our stable or brand Y? Because the differentiator isn't that big for the consumer. But it was much more about development cost. It was much more about room sizes and how many rooms you'd get on the plot, etc. So this creation of lots of brands and lots of levels and tiers, it's the only way that the brands really grow. That's how they. So I can't see that changing. But it does dilute product after a while as well. And so I think consolidation will come, or I think the pandemic will bring consolidation. I think that we'll find that there's more of a need for consolidation post-pandemic.
I see that time is ticking on, so I'm going to ask this last question. We weren't going to get into distribution, but this is a democracy, so I will ask the question. 20 years ago, the brands owned the customers. Now the OTAs do. That's true, eh? But operating terms don't reflect this. Do fees need to reduce to allow for increasing distribution costs, Robert?
Yes, for sure.
Very good.
I think they do. It's a very good question that Mark has put. The OTAs do now have considerable ownership when it comes to customers, and I think the fees in management contracts absolutely should reflect this going forward.
Yeah. Lionel?
I agree with Mark's point and what Robert said. I think we have to try and find a way where the brands can charge for the bookings they're making through their systems, but they shouldn't be charging us an additional amount on top of the OTA booking. And if the OTA segmentation reaches certain hurdles within our market segmentation, and they are way over what the brand is producing, then there has to be some kind of recognition that I could do this with the OTA directly. So, what is the brand bringing to the table? If you were to do it
with the OTA directly, would you have the heft of one of these large brands? Where
No, you don't. And this is the thing that, as an independent, when I was working with Hallmark Hotels, we had to pay through the nose to the OTAs. And when we developed the brand, it cost us a lot of money. The advantage of being with a bigger international brand that's already negotiated rates with the OTAs obviously has an impact. But I think it's, again, when you look at room segmentation, if you're seeing that you're aligning yourself to brand X, what is brand X committing to deliver through its distribution network, its loyalty, and they should have those hurdles as well as being able to use the OTAs. But if we're putting our money into this brand as the owner, the brand's got to be giving us something back, and it's distribution. That's why you're putting that brand above the door. Robert's example of the hotel that he referred to, the distribution just went through the roof because of the brand. Well, that's great. That's the brand actually, producing, delivering, and recognition to the brand for doing so. If, however, the brand's not able to do that and it's totally reliant on the OTAs, it decries the benefits of the brand. So there has to be some quid pro quo.
Yeah. Felicity?
I would love to see brands being able to take on the OTAs and have such strength in their distribution that they extracted a lot of the OTA business.
Yeah, I think we all would love to see that. And I'm going to have one final question, because one's just come in. It's a very quick answer. If you were opening a new hotel in the next 3 years, which seems like a reasonable spread, would you consider doing so without a brand? I think we can ignore if you've opening some fancy hotel over a hot spring or something else that has a unique driver to it. If you were just opening a hotel in the next 3 years, would you consider doing so without a brand? Felicity, you're opening a hotel.
I think I'm opening the Hot Springs one without a brand. I consider it very carefully, but I suspect that the funders and the valuers pay such attention to the brands, there would be little option.
Right. Lionel, you have a brand. Would you consider?
No, you've got to be with the brand for me at the moment. The question was very specific. It's in the next 3 years. And I think the brand will have power, brand will have recognition. And it's not just the recognition from the consumer, it's the recognition from the bank and the valuer and the whole jigsaw. We can't look at it as a single sort of piece of the puzzle. It's the whole puzzle.
Robert?
I hate to give a politician's answer on this, but for me, it sort of depends on product, location, owner, expectations.
You're going to get into detail.
And also who can execute the launch plan. But on balance, probably yes.
Wonderful. Well, I'd like everyone to silently join me thanking the panel in creepy Zoom land. I would open with a brand, if only because I'm down to my last branded pen at the moment, because I haven't been to any conferences this year. So in about this much time, I'm going to have to start buying pens. So there's indeed desperate times. So for everyone who's on, some final housekeeping. If you dialed into the webinar, please email events@wfw.com so that we know you attended. Tomorrow you will receive a follow-up email which will include a short feedback survey. Remember how much you enjoyed us, how much we know where you live. Your feedback is very important to us to ensure that we're delivering events that are relevant and engaging, which I think that this one was. So thank you all very much for attending.
Well, thank you all, and thank you, Katherine.
Thank you.
My absolute pleasure.
Thank you.
Bye. Thank you.